Welcome back to the Invest in Value channel. I'm Victor, and I wanted to cover an insurance company. Why invest in insurance companies? Well, this one, Allstate, pays a nice dividend, and insurance companies tend to be good, stable stocks, good, stable companies to have. I like income out of stock investments, and a nice 3.3% dividend is right up my alley. I'm going to take you through my investment in Allstate, give you my analysis, how I found an intrinsic value in this company, and why I've decided to invest in Allstate. I'd also like to give you my go forward plan with the stock, whether I'm going to be buying more shares, holding, or selling my shares. I follow a process when I invest in stocks, and the process involves 4 key questions that lead me to a decision whether I should buy, hold, or sell a stock. First question's really important. Do I understand the company, and do I want to own this company? In short, Allstate is an insurance company. I've been buying automotive insurance and homeowners insurance and a couple of other different insurances for a long time. That doesn't qualify me to be an expert by any means. So I've put in some time in understanding what Allstate's about, looked at a number of insurance companies to see if it's a good investment. And I like what I've seen from Allstate, and I think it's a company worth considering. The industry is a good one. Insurance companies have a lot of smart people that, took that really difficult math back in college that could really estimate what their losses are going to be. And insurance companies tend to be profitable. They tend to know which markets they want to insure in. They tend to know what they're doing, and they reward owners with a good return typically. So I do want to be an owner in this stock. I do want to own this company, and it's a good industry that I want to be a part of. Is the company operating and performing well? Well, I'm going to answer that question in the next couple of slides. Is debt less than 3 times EBITDA? Debt and cash for an insurance company is a little different. I'm going to get to that in a few slides and tell you what my assessment of their balance sheet is for this company. And I want a discount on the stock. So once I do a valuation, I can determine, would I be getting a discount on Allstate at the current time? And that would then lead me collectively the answer to those questions. Should I buy, hold, or sell this stock? So what's the story on Allstate? And do I want to be a part of that story? So Allstate's a big insurance company. I'm sure you've seen their commercials. They're easy to understand. They insure cars, houses, and a variety of different personal items, and they pay on claims. They charge people money and they pay out claims. The company historically has been profitable. I like that. The company pays a 3.3% dividend. I like that. The industry is a good industry to invest in. Warren Buffett really likes insurance companies. I think Geico is his big investment. I've analyzed Allstate against Geico, and I like Allstate more. So I like the company. I like their story, and I want to be a part of it. The company has a solid balance sheet. And with an insurance company, you got to look at a couple of things. First, you got to look at their total investments. As they are getting paid all these premiums, they invest that money so that they can pay out, should there be a big, storm or a lot of cars get wrecked. And they have a very sizable, fund of invested investments totaling above $63 billion. They have some cash to operate the business with. And if you look at their reserves, insurance companies have to determine, hey, how much money do we think we're going to need to pay out in the future? And they expense that amount. So these are all the reserves that they've been expensing, and they have this reserve account in their balance sheet at $38.6 billion plus $1.3 billion. So collectively about $40 billion in reserves. And then they also have some debt, a little over $8 billion in debt. But as you can see, their investments and their cash far exceeds what they have in reserves and in debt. So to me, the balance sheet is in solid shape. Looking at their revenues, the company has had growth over the last 5 years. If you look at the growth over the last 5 years, they've grown 40%. So looking as a long-term play, good growth. I mean, this is insurance, is a big insurance company, so I'm not expecting massive growth. So good growth there. Now, this is their most current quarter that ended on March 31st, and their total revenues again grew compared to last year, the same quarter, but their expenses also grew. And keep in mind, expenses for them is what they're expecting to pay out. It not always means that that's exactly what they paid out, but it did increase significantly, which led for them to be unprofitable. So they lost money on their P&L for that quarter. And last year, they actually had a profit in that quarter. So that's one thing to keep an eye on. As we look at their earnings per share, it's expected this year that they're going to be at 57 cents of earnings per share. In the first quarter, they lost money, as noted in the previous slide. So this year, it's going to be kind of a lean year when it comes to earnings per share. But keep an eye on next year. Next year is going to be a very good year. 12.69 is going to be their earnings per share. So if that comes true, I think this stock could really go up. So I'm going to keep an eye on that. So let's take a look at the statement of cash flows, which tells us how much free cash this company is producing. It starts off with this year, they've had a loss of 321 million, or excuse me, this quarter. This is a quarterly statement. And one thing that I'll want you to keep in mind is, these are the reserves that this insurance company is having to make. It's not a cash item. They're saying, hey, this is what we think we're going to end up paying. And that was over $1 billion. So that's what drove an increase in free cash, because it wasn't a cash outlay. It was just a reserve. So if you study your accounting, that's what it was, which leads to the company actually having positive cash flows in the first quarter of 2023 of $601 million. They don't have to spend a whole lot of capital to keep this insurance company going. So the CapEx was only $79 million. So that really provided for an increase in free cash flows from $302 million in the first quarter of 2022 up to $522 million in the first quarter of 2023. Really nice improvement in free cash flow year to year, even though the company was unprofitable. So here's my valuation on Allstate. I'm going to take two methods. First is I'm going to value the free cash flows that I expect from this company. And second, I'm going to look at earnings per share. So looking at free cash flows, what I did is I took the first quarter of 2023, multiplied it times 3 to be conservative. I get $1.5 billion of free cash flows expected in the current year. I'm going to grow those free cash flows by 3% and 3% long-term growth. Based on that and a discount rate of 9% weighted average cost of capital. It's a good company, but that's a conservative weighted average cost of capital to use. And here we get an intrinsic value of those cash flows of $24 billion. I add the investments in cash and take away all the reserves and debt out of that number, and I get to an equity value in this company of $40 billion. That's what I think the company is worth. Their market cap is $35 billion currently. When I divide the equity value divided by the shares outstanding, I get what I believe is an intrinsic value of $152 per share, but the current stock price is $107 per share. So using the discounted free cash flow method, there's a discount of 41% if we just use that method. But I use two methods. Earnings per share is also a method that I use. Their earnings per share is pretty low. It's 0.57. Their PE historically has been 24. And that gives me a stock value of $11, way below their current stock price. I take two parts, the discounted free cash flow method, one part earnings per share value method, and I get to $105 per share is a fair price for this stock at the current time. So as you can see, it's actually selling at a 3% premium. And that makes sense. I think they're in a transitionary year where earnings per share needs to get better. And if this improves, then I think the valuation of Allstate will also improve. The stock price year to date has gone down 21%. So the concerns around earnings per share and the profitability are real. And I think investors are waiting to see if the company can get back on track and be really profitable. This is an opportunity. I'm going to be watching this stock and watching it so that if they make a turn on that profitability, and they should be announcing their earnings in the next 30 days, this stock could really take off and really go up in value. We provide a recap on Allstate. So their stock price is down year to date 21%. And it's really because of that net loss on their income statement that they've had. They have positive free cash flow, which is very good. And they pay a dividend of 3.3%. It's nice to have stocks like these that pay me a nice income. I like having dividend stocks as in one of my portfolios, which was my income portfolio. And Allstate is definitely in that portfolio. They're growing the revenues, very good sign. And I think going forward for the remainder of 2023, the revenues will grow, and I expect that they're going to return to profitability. Therefore, they're going to generate a little more free cash flow. It'll be good to see their next earnings call and see how they're doing on free cash flow. Their investments also will be earning a higher rate. It's no secret that treasury bonds and just about every fixed income investment is producing a better yield. So it'll be good to see if they're producing a better yield out of their investments. My outlook in 2024, if their earnings per share really recover, and if they get to that $12 per share, holy smokes, this stock could double in 2024. So I'm going to keep an eye on that. It's a good dividend payer at 3.3 currently. And really the next quarterly results are going to be important to take a look at and see if the company's making that turn to profitability. So let me scorecard this investment. Do I want to be in this company and in this industry? Yes, I want to be in an insurance company. And I have two insurance companies, Prudential, and I have Allstate, and I have some healthcare insurance companies. But this one here is the only automotive, casualty, homeowners insurance company that I own. They are operated well. It's a good management team. They really know what they're doing there. Their debt is I'm comfortable with their debt level. I reviewed that. And there currently is no discount on this stock. It's fairly priced. So therefore, that check mark is a deal breaker for me. I'm just holding my shares, waiting for the next earnings call to see if the new earnings change my valuation, and then lead me to make another decision whether I want to hold shares or sell them or buy some more. Hey, thanks for watching the video. I hope you enjoyed it and discovered something new about Allstate. It's a good company to take a look at. Please keep in mind, I'm not making any financial advice recommendations. I'm not recommending you buy Allstate or any other stock. I share my experience as an investor, and I hope you found it interesting. Good luck investing in 2023.